Welcome to the Silent Trading channel on Thursday the 2nd of April. Today I'll be analyzing the gold chart to check and see if the price action right now is on the bearish side or the bullish side after a dump below in the 4 hours chart, right? But before I start, please subscribe, comment and share if you like this video and to support me in my trading journal, okay? So I'll be going through the 4 hours chart first because the 4 hours chart has seen a dump in price, right? And then a bearish price action, right? As you can see, this dump in the price, as I've said before, that after pushing up for a while, it will then start to retrace, right? A small retracement is when a chart push up, right, break resistance and then directly retrace at the next candle, correct? But this retracement over here is a big retracement, right? A big retracement is not by candle, but this is a big retracement on the big trend, right? It can either happen on the daily time frame, right? A big retracement like over here, right? On the daily time frame, the daily chart. This is a big retracement over here and a dump to below, right? Attack the first support, accumulating buy side volume at this support over here and then dumping down, taking out buy side volume, right? Taking out buyers. And after taking out buyers, it is then right now pulling back. So right now we wait to see if this pullback is a valid pullback. Is it going to pull back and close above support? If it pullbacks to close above support, it is telling us that the price action is still on the bullish side. Because why? Because the daily time frame hasn't break support yet, right? But now it has attacked, accumulate, right? Attacking support means accumulating, and accumulating means the chart has to dump to take out buyers, because support is used to accumulate buy side volume, which is also accumulate buyers, right? And after taking out buyers, it then start pulling back. If by today it start pulling back to close above support, which means it is not able to break support, and if support is not broken, the next candle would maybe be to push up, attack resistance and then break, right? And then break above. Okay, so right now we wait to see if this daily time frame chart is going to close below support or not. If it is going to close below support and then form a bearish price action over here, we can then start waiting for the chart to retrace above while not attacking resistance, and then we can start selling, right? So there will always be opportunities to enter a position no matter at which price point in the chart, but it all also depends on the current price action of the chart. But we always wait for a confirmation before we enter a trade. We never enter beforehand. We enter only after a confirmation is shown, is revealed, right? So the daily candle doesn't show us much, right? Besides just breaking below and then start pulling back. So we need to focus on the 4 hours chart. The 4 hours chart right now has already break below, right? After the 4 hours chart has formed a bearish price action, right? And then a candle push up to form a top wick. And after forming a top wick and wasn't able to close above resistance, it then start pulling back and then start accumulating buy side volume at support, which is the first support over here, the second, the third, fourth, fifth, sixth, right? And then the latest candle, which was a bullish candle, has pushed down, right, to accumulate the 7th support yet? Nope. Has it been accumulated yet? We'll look to see. The 7th support over here is at the price point about 4555.17, and the low wick over here is 4553.16, which means the chart, right, this candle has already attacked this support. But why after attacking this support hasn't it pushed down first? Because after pulling, right, after pulling buyers into a deep drawdown over here, into heavy drawdown over here and then dumping, those buyers would either close their position after dumping, right, or either they will start entering sell side position to hedge their order, right? So this support normally would used to be accumulating buy side volume, but instead after pulling, right, after dragging and trapping buyers in the drawdown above, right? The buyers will need to hedge using sell side position, which means this support may be the place that buyers are using sell side position to hedge their position over here, right? To lock their drawdown, to lock their losses. And after entering a sell side position, the price then start pulling back up and then start trying to go up, which means right now there are buyers over here. There are also sellers over here, which is the reason why when the chart push up and there are too many buyers, the chart start dumping. And when the chart start pushing down too much and there start to be a lot of sellers, right? Sellers start coming into the market, the chart will then start pulling back up, which is a reason why the market always clears off retail traders position, right? Volume from retail traders are always taken out first before the market will go on its initial trend. And this is a proof of it, right? After leaving sellers below, start pulling back up and then start pushing up. And this spot over here, it has already formed a bullish price action. But is this bullish price action valid yet? Nope, it is not a valid bullish price action yet, because this bullish price action is not complete yet, right? It needs to be complete at where? At least the next candle over here needs to at least push up, close above previous candle wick. Will we then call this bullish price action a valid one? Or at least it is a valid one, but not a strong one yet. A strong bullish price action must at least close above resistance, because closing above resistance means attacking resistance and start accumulating sell side volume. And by the chart starting to accumulate sell side volume, it is already telling us that it is trying to accumulate sell side volume and then trapping sell side volume below and then start expanding up, right? Because retail traders are always trapped in the chart. It is either trapped in a sell position below or trapped on a sell position above, right? Retail traders are always going to draw down. So if the chart is pushing up and to start accumulating sell side volume, it has to at least touch this resistance over here. And by touching and also breaking resistance, and breaking means closing above resistance, it is then telling us that the market right now is ready to go on the bullish side, and then it will start expanding at the next candle retracement, right? A retracement to form a bottom wick, and then pulling back and start expanding upwards. So all in all, the chart is always telling us something if we really pay attention to it, right? If we never leave out any detail and we pay attention to everything the chart is telling us, we will always see traces of movement that is telling us that it is going up, it is going down, right? And I have said beforehand, yesterday, even the day previously, that after a strong bullish structure, it will at least need to break below, dump below, to form a new base price. Or either if it is not forming a new base price, it will then either go on a bearish expansion. So right now, this push up over here could be a retracement to go down further, or this movement up could be a movement up to complete this bullish price action and then start retracing and then start expanding up, right? So it can be two things. But the problem is, how do we identify that it is going up to go down, or it is going down to go up, right? This can be a bullish price action to go up, right? To form a strong bullish structure and then retrace and then start breaking resistance and then retrace and then start breaking resistance, right? We do not know if this is going to happen or not, at least until it has break at least one resistance, right? Or it could be a push up above, right? Or a push up above, right? A break over here, a break above, retrace, and then another break above, and after that start forming another bearish price action, which is also a base price that has a lower resistance than the previous resistance, right? This is a new base price, and then start forming a bearish price action. After forming a bearish price action, push down, attack support, and not just attack but also break support. Then the next candle retracement is where we're gonna sell, because by breaking support, it is telling us that it has it is needed to go below. It is needed to dump once more. So once the bearish price action is formed and complete, it is then called a valid bearish price action. And if a valid bearish price action is formed, the next candle retracement, we are going to be selling and then wait for the chart to dump on us, right? So this is all we're going to be waiting for. We never wait pointlessly. We wait for the best possible spot to enter a position, either on the bearish side or the bullish side, because every spot there is always a chance of profiting. But for me and for us, we need to be able to wait for the best possible spot to enter a trade. If there is a spot that is a 99.99% winning rate, we're going to wait for that one. But if today there's only an 85%, the highest percentage of winning is 85%, we are also going to wait for that 85%. If the highest rate is 90%, we're going to wait for that 90%, right? No lesser than that, because lesser than that means you're risking more than you should, right? If the best possible risk today, right, if the best possible winning rate today is 90%, we wait for that 90%, and the least is 85%, right? We do not compromise too much in the chart. We do not compromise too much in the market, because by compromising and risking more than you should, it is already telling yourself to go lose money, right? You're not telling yourself to win. You're telling yourself to go lose money. You do not care how much money that is lost, right? So we do not trade to lose. We trade to win, and we do not compromise our risk management. If we told ourselves beforehand that we wait for the best possible spot, and the least possible spot and the worst possible spot is at least 5% lower than our best possible spot, that is acceptable. But lesser than that, we do not play, we do not trade, right? So if today's winning rate is 90%, we wait for that 90%. The worst is 85%. But if today's winning rate is 70%, right? If the best winning rate today is 70%, we wait for at the least, the worst one is 65%. No lesser than that, because lesser than that means compromising. Compromising means you're putting yourself into more riskier situation, right? So every day there will be different scenario, different risks, different situation for you to trade. But in every situation, there will also be a certain amount of risk involved, a certain amount of winning rate involved. So if the winning rate today is the highest it can be, we wait for that highest winning rate, right? If that winning rate, if that certain spot, that specific spot doesn't come, we do not enter any trade, because we are not compromising ourselves to more and more risk, right? We are managing ourselves into lower risk, higher return, right? Not more risk, more return. We make ourselves trade with low risk, high return, correct? So every time we enter a trade based on our true understanding that the chart is really not going against us, and then we trade on the specific spot, right? At that bearish price action, at that bullish price action, anywhere you see a real price action forming, you can enter at that trade. But at least look for the best possible spot to enter. Don't put yourself in unnecessary risky situation, right? Less risk, high return. There is a less risk, high return trade, but you need to wait for it. You need to be patient, okay? So for today, that is all I'm going to be analyzing for you guys. It is all I'm here for today, and we'll see each other again tomorrow after the non-farm payrolls, right? And for today, that's all I'm going to be here for, and I look forward to seeing you guys tomorrow. See ya.